Thank you.
Okay, so once again, let me thank Marco Avallaneda for accepting the invitation and talking to us about a holistic and practical approach to risk managing equity derivatives. Marco, please.
Thank you. Again, I decided I'm going to speak English because I tried to speak Portuguese and have English transparencies, but it doesn't work, and I get neither right. I mean, I did not prepare Portuguese slides because of lack of time, so I apologize for that, and I'm going to speak in English and read my slides in English. So this talk is going to be about risk models and equity derivatives. Everybody, as you get older, you try to make money, speculate, teach stochastic calculus. Then at the end, you become risk manager, mostly because of your age. Because most people, half of the people in this room were not in the internet bubble. They were studying, or maybe they were in school. So people like us, older people, always have the advantage of not of intelligence, at least of experience. That counts a lot in risk management. Therefore, I've looked at risk management for a while, and today I'm going to talk about equity derivatives. So the goal is to create a risk model for portfolios, which is based on statistical movements of equities, ETFs, indices, and options on all the traded equities in the United States. So the goal is very simple. The thought experiment that you have to think of is you decide to become a trader, and then you start trading stocks and ETFs and options, and you want to know your risk and what model should you use, which reflects the risk factors of your portfolio. The risk factors of a stock portfolio are generally considered to be the stocks, and the risk factor of a stocks and options portfolio is generally considered to be the stocks and the implied volatility of the options. How many people here know what implied volatility is? Raise your hand. How many people never heard of implied volatility? Good. Then you belong to, there's a class this class may be a little bit above your head. Okay, so the approach here is to create a risk model by generating theoretical scenarios for the risk factors by Monte Carlo simulation, and use the scenarios to compute the portfolio risk using the standard measures, which are 99% VAR, 99% 5 expected shortfall, or a combination thereof, and so forth. And the question that I would like to ask today is how many risk factors should you build to create such a model in practice, right? Second, should you use a parametric versus non-parametric risk factor model? So the choices are, you could use a stochastic volatility like Stephen Heston, that means that you would create a machine that maintains all the Heston model for all the stocks and their correlations, or you could use the local volatility of Bruno Dupier, who's here, or you could use the implied volatility of Black-Scholes. Because this is a risk management system, it's better to use Black-Scholes, although the jury is not completely out on that. The question is, there's an advantage of using Dupier or Heston, which is that you're guaranteed your model is better, is more theoretically better, but it's harder to implement, and so this means that already here in this first transparency, I have some open problems for you. So if you listen to my talk, you may want to do the same thing with Heston or Dupier. So so the goal of the talk is to actually show you how the model is built, take you through a little trip, a tour. I cannot give a tour to the Corcovado or but I can give you a tour to volatility. So that's what I'm going to do. It's not going to be as fun, but we're all here, It's raining, so I'll give you a tour on volatility. And so let's start with a few kind of things we could do with volatility. For example, if you look at the blue line, this is the S&P 500, which is a SPY, it's an ETF, the June 2015 IVOL for Friday, January 16 of this year. Oh, I'm sorry, yeah, this is actually, it expires, so the settlement is Friday, January 16, and this talk was prepared recently. So we see here, blue is the so-called skew. It's for a particular settlement. Now, if you want to do risk management, you have to move these things. In risk management, the whole idea is not what my price is, but what could my price be as the products change. If I own options, if I own a portfolio of options or whatever, the first question is, how much are these instruments worth? Why? Because I have to go home and I need to report my P&L to my back office. So you need to know the price. The second, how much would they change in 1 or 2 days? That's important because that makes you keep economic capital. Without economic capital, you cannot do. You have to keep reserves, and you supervise. So you have to report this number. So here is what people do. They shift these volatilities up and down. So this is a parallel shift, and this is a tilt. So the questions that I want to ask again are, how do we think of the factors that drive the entire equity derivatives universe, and how do we correlate the different volatility surfaces in practice? So your job is to come up with a portfolio, with a method. The outline of the talk is therefore going to have several pieces. That's why it's kind of like a tourism. It's going to do cross-sectional study of the market. And I'm going to use PCA on implied volatility surfaces to show you the diversity of how implied volatility surfaces move. Some of them I would call systemic stocks, and the other ones are going to be called idiosyncratic stocks. That does not mean that they have systemic risk, but they respond systemically. For example, Goldman Sachs is systemic, and maybe some other company like Cigna is not systemic. The second is dimension reduction. In order to move the whole market, because that's why I call it holistic, because you want to move the whole market, how do you properly reduce dimension? And then there is going to be a little piece, which I think is interesting, about the joint correlation analysis of all the stocks and all their volatilities together in one big Monte Carlo. And the main tools that we're going to use are elementary data analysis, principal component analysis, and then something that IMPA, I'm sure, is very interested in. It's called random matrix theory, in particular the theory of Marchenko-Pastur and Tracy Whittam, which here is used to separate noise from signal. And this is the key thing that allows us to reduce dimension, to separate the noise in the market, or the residual noise, from the actual drivers of the market. The noise is characterized by so if you look at it from a spectral point of view and correlations, that's Marchenko-Pastur. And then after all, we do this, then we have to do it fast. So there's a third part of the talk, which is going to be numerical linear algebra and fast SVD, Rocklin, Lamb, and Tigert. This is something using big data. It's connecting to the 21st century. You know, how do we do linear algebra fast? Big linear algebra fast. And then basically, then we can build all these scenarios. And then I'm going to present an application called Iceberg, I hope, if I have time, which actually does this. And you can actually get if you ask us, maybe we'll let you be a beta user of this. But if you don't trade options, probably you're not, so it's going to be boring just to look at it. So for the first part, which is that part about the trip through all the volatilities of the United States stocks, I'm going to use IV option metrics, which is available at WRDS, is a public database, which gives you daily closing prices and implied volatilities from OPRA. OPRA is the Option Pricing Research Authority, is the United States official provider of settlement prices for options. The data format are snapshots of implied volatility surfaces, which are basically averaged of implied volatilities using a Gaussian smoother. The size of the problem are there are about 77,000 optionable securities, and we kind of work with 50 delta maturity points. They're actually 130. Approximately 910,000 variables, just to impress you that it's a big problem. It's a big problem because, you know, in Brazil we have 600 stocks that trade, but there are only maybe 10 stocks that have options. And of those, there are only 3 stocks that have liquid options, Petrobras, Vale, and Eletrobras, Usiminas, or whatever. But in the United States, we have 7,000 to 9,000 stocks which have open interest every day, that there's a settlement price. You have to, you know, you have to do it. Everybody has to declare. And you know, they're listed. That's why Oprah exists, because Oprah provides those prices. And what we have to do, our goal as mathematicians, is to advise people into how you would build a model where everything moves together. So first of all, let's start small. How does a volatility surface move? So to find that out, we're going to use this. For every underlying stock, ETF, or index, we form a small matrix of 53 by, I don't know, 5 years, 1250. 53 why? I take the underlying stock and I take 52 implied volatilities. What are the 52 implied volatilities? I skipped that. They are here the 20 delta to 100 delta calls or puts, and maturities 30 days, 90 days, 6 months, and 1 year. So it's a grid. So we take that grid, and that is our points. And we want to find out the grid and the stock, how they move. How do they move? Do they all move together? Do they move separately? How do they move? So what we do is we start with the S&P, which is mother's milk here. You know, the S&P everybody has to know. And the S&P, you know something that everybody here, including Bruno, worked on this many years ago. Basically what happens is that you have 2 or 3 eigenvectors that matter. The spectrum, let's look, this is different. These are eigenvectors, this is the spectrum. There's one big eigenvalue of 95%. And then there are 2 small eigenvalues of 2% each. And then there is a little bit of eigenvalues that we don't really believe that they mean anything. So the first eigenvector says vol up, stock down. It means all the vols go up and the stock goes down, which is the same as saying stock up, vol down, because eigenvectors are defined, am I in IMPA here? Yeah, modulo sign. Eigenvectors and eigenvalues are defined modulo sign. So that means that this is the basic mode of SPX, and these other modes are difficult to interpret because we have actually ordered these things by strike and then maturity, and 4 maturity buckets and strikes, but they have something to do with skew moves, either the time skew or this. But I don't recommend that you try to figure it out by looking at this graph, because your mind is going to, you know, melt. This is another picture of the eigenvalues, but it's bad because it's done in MATLAB and the scale is bad. So mostly this is equal to 0 because it's 10 to the minus 3. And these are slightly different from 0. So these look very exciting, but they're not, because they're completely mangled. They're sort of saying that things don't move in parallel, but the amount of energy, the amount of variance explained by non-parallel moves in the S&P is very small. Then we pass to the 20 most liquid ETFs. And so, for example, S&P has basically the first eigenvalue. That means that first eigenvalue explains about, you know, a huge amount of variance here, right? But for example, Brazil, less, right? This is like 90 something. The major indices, S&P, emerging market, and Russell and QQQ, but Japan ETF, VIX ETN, which is a volatility ETN, very low. Brazil, the EWZ, small. Treasury, small. So in other words, these guys, Brazil has other moves, yes, that are not just, because Brazil is not in the US. It trades in the US, but there are other things that matter, right? As we all know, the Treasury market also has the central bank monetary policy that is not related. It creates moves, and the Japan ETF is the Abenomics ETF. You know, so if you look at the histogram of the first eigenvalue of the implied volatility surface that shows the vibrations, you see that the S&P is here. Mostly everybody is here. The first eigenvalue explains 90% of the trace of the correlation matrix here, 70%, but there are a lot of stocks that only explains 30% and so on. So that's kind of interesting. What are these stocks? So the top and the bottom stocks ranked by eigenvalue. The bottom stocks, I'm sorry for this thing, we glued together 2 things. These are the bottom stocks, these are the top stocks. So the top stock is Goldman, 87, JP Morgan, Bank of America, Schlumberger, Caterpillar, Apple. These are all names that for us are like the top names, for example, Lojas Americanas, you know, Semig, Petrobras, Vale, they're here. They're the systemic stocks. They're the ones that are really driven by the first eigenvalue. On the other side, you have these stocks that no one heard about, and those are so that means that we have an irony. If we want to develop a risk model that does all stocks, We cannot work off only a few risk factors because there's a lot of risk in the low stocks that have to do with movements that are not driven by parallel shifts of volatility. And these movements are important, and we'll explain why. This is not important. This is the second eigenvalue and the first eigenvalue. So the classification that I propose is that there are systemic equities, that means equities that have a large eigenvalue, first eigenvalue, and idiosyncratic equities that have a low first eigenvalue. And yeah.
Your decomposition of PCA is weighted, is volume weighted, or it's just?
No, it's just PC. I'm just going like with a, I'm not being very careful. Volume weighted, you mean by, what do you mean by volume weighted? Huh?
You're equally weighting the small stocks and the
No, I'm doing it each of them separately. For the time being, I'm looking at, I'm trying to create, essentially, I'm trying to ask this question, how many factors do I need to describe a volatility surface of a stock? So if you look at S&P, you might say, I need 3. But I'm telling you, no, you don't need 3, because in options, you need more than 3, because baby stocks have a much more exciting volatility life in a way. You know, it's like, basically systemic stocks are for market makers, baby stocks are for Mike Lipkin, you know, which is a friend of ours, which means are stocks that are very difficult to trade, volatility-wise. So, systemic stocks are very much driven by the market's risk appetite, Fed, Ukraine, China this year, right? Idiosyncratic equities are affected by corporate events, company-specific news. Changes in this Q of the IVS are more important and more variance-wise than in systemic stocks. Idiosyncratic stocks have typically lower capitalization and can be subject to takeovers. Therefore, you have a volatility surface that is in backwardation instead of in contango, can have larger earning surprises and weaker guidance, subject to surprises, biotech, social media, gaming, stocks, and so on. So you cannot have a risk model which is universal, holistic, using only 3 eigenvalues, which is ironic because most of the trading volume, as Rafael was saying, may be on the top 5 names. But you can't, but if you're clearing, if you're creating risk management for any portfolio, you have to put those things in. So how do you put them in? Okay, so the question is, how many eigenvectors do I need? I'm going now towards what's the right amount. So for this, I have to look at the matrices, the correlation. I decide to look at the correlation matrix and apply random matrix theory. This is going to be the second leitmotif of this talk. So the idea is take your data, form a correlation matrix, XX transpose. It's a random matrix of random variables. Suppose that it was a random matrix. This is a mathematical result. Oh, this is a theorem. It's a mathematical result. If you have a random matrix of Gaussians, and you construct the empirical correlation matrix or covariance matrix, as n and t, as the row size and the column size both tend to infinity on a fixed ratio, the density of states, the number of eigenvalues below a level, the fraction of the number of eigenvalues below a certain level converges to a fixed deterministic distribution discovered by 2 Russians called the Marchenko-Pastur distribution. The Marchenko-Pastur distribution is the equivalent in the quadratic thing to the Wigner semicircle law. It says that if you have a fully random matrix, in the limit as n and t go to infinity, you don't converge to the identity, even though they are d, because they're not square. It's not in order for it to converge to the identity, t must grow much faster than n. And that means that you have much more sample than variables. If t and n both go to infinity, then you have this business here. And this function, what for important for us is it has a finite support, and its top eigenvalue tells you how big the random spectrum of a matrix can be, given the dimensions. And in the case of a random matrix of 53 by 1257, the number is 1.45. In dimensionless units, it's 145. If you have a matrix of data of 53 columns, 1257 rows, then any eigenvalue below 145, you can say that it's noise. This idea was put forth by Lalou and Bouchot and Potters, by the French. Again, the French, they always add stuff to this field. And that is true. They seem to add good stuff. So here's a picture of the spectrum, the density of states of the S&P 500, and here is the Marchenko-Pastur distribution. If you've lived around New York for a while, you've probably seen this picture. And then these are what we call the significant eigenvalues, and this is what we call the noise spectrum. So the idea is you chop this off. You chop this off at lambda plus, and you say, I have the number of significant eigenvalues, and then you model the rest as residual noise, right? We're in mathematics here, so I can talk fast like that, right, Nicole? We don't know. But this is something we can do. It's like gym. Is gym good for me? If I run in the thing, do I get skinny? I don't know, but I can try. This is what you try, right? So the number of eigenvalues above Marchenko-Pastur across many optionable stocks, there can be like 1 or 2 with the S&P, up to 9. So there's some beasts out there that actually have the full movement of the surface. You might say, yes, it's noise, these stocks don't count. But since I'm building a system that holds for all stocks, I have no choice. I have to include some. So my idea is that I probably need around 9 volatility points to model a surface, around that much. So, okay, let's skip this. Well, then this is some nonsense. So this is it. What is a reasonable number of risk factors needed to parameterize a generic implied volatility surface? We're going to, since we're inspired by this PCA analysis, let's take the 52 points or whatever. Let's call a pivot a point on the delta tenor, on the delta tenor surface. Let's call it a pivot. How many? Now we want to take that surface and model it. The surface is a bunch of, is like a bunch of things like this. The pivots would be, I take this one here, this one here, this one here, like essentially a reduced grid, and I'm going to then claim that everything else is pretty much risk-wise, not really, but from the point of view of risk scenarios, is a linear combination of these things. Just like when you do swap risk management. You take you took some points on the swap curve, you don't take every single swap, and then you kind of move it up and down to create that. So the schemes that we tested are with 2 pivots. See, this is 25 delta 1 month, 25 delta 50 to 75 3 months, 25 50 75 6 months, 25 delta 50 delta 1 year. So a 2 pivot would say I take at the money 30 days, at the money 1 year. 4 pivots at the money 30 days, at the money 1 year, and then across 25 delta and 75 delta. Here you put more at the money. Basically, 12 pivots is you take everything. 9 pivots is you just take this is our internal classification. We tested them all. This is the picture. The 9 pivots came. After a shock, the IVS variation is assumed to be a linear combination of the changes in the surrounding pivot, so you have enough noise. And then you look at, for example, before you actually propose this, you can say, how much better do I approximate EV1 of a particular stock as I input more pivots? This is an idea of a student of mine. It's okay. So with 2 pivots, you have an error about 40% on the top eigenvalue for some names. Then it goes down. 6 pivots, 20%. 9 pivots, 10%. Then 12 pivots, 8%, but this is too much, too long. In fact, what we decided to do in practice is we only take 12 pivots for the S&P because the S&P has longer maturities at trade. There's a lot of vega in the longer maturity, so the market prefers to have 12 pivots, but basically 9 pivots. So that means that now we have decided that we have 7,000 stocks or whatever, thousands of stocks, and we have 9 points for each stock. Now we're going to look at how this system moves. Each stock and its 9 implied volatilities. So what is it that we have? We start here with a big matrix. And let's talk about the correlation matrix, because it's Monte Carlo, you need a correlation matrix. So this is Apple. And this is, I don't know, Yahoo, right? So Apple really is a 10 by 10 matrix. Why 10 by 10? Because this thing is Apple, this thing, for example, here is a correlation of Apple and Yahoo. This is Yahoo volatility. This is the correlation, is Apple-Yahoo correlation. And these are the correlations of volatilities of Apple with other volatilities of Apple, which describe the movement of the surface. And then there are correlations of this volatility of Apple with that volatility of Yahoo. What can you do? That's the bed that we made, and we have to sleep in it, right? What can we do? So now, how do we clean up this mess? How is this mess cleaned up? We're going to do PCA. So we're going to find out what remains after we clean. That's the beauty of cleaning data. So I hope you understand the model. I'm trying to describe this correlation in a civilized way. So we determined that for each equities and their listed options, you have 9 pivots. Now we want to use this information to compute the correlation matrix. We study a reduced set. We don't have 10,000, we have 3,000 over 2 years. The dimensionality in column space is 31,410. We use 2 years. Every time everybody comes up with a different test. Idea, follow Lalou, Bouchot, and Potters, use PCA at random matrix theory to extract a set of significant eigenvalues and eigenvectors. We look at the lambda plus. The lambda plus is 79.67. And then we basically, is Marchenko-Pastur valid for stocks? Okay, so this is a funny story. Yeah.
Let me repeat now my
Yeah.
question.
Repeat again.
The exact same answer
Yeah.
in here, because now it's relevant.
What do you want me to repeat?
No, the fact that you analyze the whole matrix without weighting the different stocks,
Weighting how?
like the volume,
The volume of what?
the volume, trading volume.
But you have trading volume of what? Of stocks or of options? And if with options, near-term options or far away?
It could be both.
No, but no, because that happens.
Just twice, so you don't
Okay, no, the answer to that is I do not use any volume here. And the reason why I don't is because I'm trying to extract a set of risk factors and econometric risk factors, and volume considerations appear later because we're no longer children, unfortunately, but they appear in questions of liquidity, not of, we separate mentally, probably wrong. We have a mental separation between market risk and liquidity risk. So this only affects market risk. Is this separation okay? Of course not. Nothing is okay. This is all a big, beautiful world of everything, everybody's mixed, and but the way that the culture is you have to separate volatility from stock price, for example. It's not the same. Bruno gave a talk on volatilities. It's a bond and a volatility is not the same. Actually, it is the same. It's all money. So basically, it's all money, but I cannot put volume here. If I put volume, I would get a different theory, and you will do that theory. And you will stand here next year and tell me why it's different, and we'll be happy to hear it. This is not finished. This is not a, this is a recipe to make a cake, right? Huh?
It was not a critic.
No, but you can say anything you want. I don't care. This is what I did. I did this. Any of these things you can do differently. No? Why? Because this is something called the social sciences. It's social sciences. It's not natural sciences. Even in natural science, you could do it differently. Yes?
10 minutes.
10 minutes, I can do anything. I'm a 20-minute man. Okay, so 79.67, fine. So is Marchenko-Pastur valid for stocks? People say the fat tails are too fat, blah, 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 blah. So checking that Marchenko-Pastur applies to marginal distribution of returns. This is an idea that I have never seen before in academia. You look at the data and you randomize the columns to break all correlations, to make it into a random matrix, and then you test to see if you recuperate the Marchenko-Pastur spectrum. So if you're given data and you say, is this data in the universality class of Marchenko-Pastur? I'm not sure. So let me randomize the columns, standardize so everything is variance 1, and then I can create an ensemble of 10,000 such matrix, for example, compute the average loss, compute the distribution of the largest eigenvalue, and do it for a bunch of things. And It's amazing. I did not cook this up. It actually works really well, at least for stocks. For options, here we're among friends. I think there's some more tested needed. But we use it anyway because we don't have anything else, right? So anyway, yes. So, and Tracy Whittem, that Georges loves Tracy Whittem because it's an integral system, it works like a charm. In other words, Tracy Whittem says what the distribution around the edge of the top eigenvalue is, using a distribution that is way too complicated for me to understand, but I can do the data work. See, because mathematics, applied mathematics, is not just doing the theorem. It's taking the theorem, passing it through data, getting the result, interpreting it. It's a profession. It's a clinical business. So here, we actually ride on the shoulders of giants and use Marchenko-Pastur, and we apply Marchenko-Pastur to a problem that no one did it before, and that at its moment it was important because we could do something with it. And we find that there are 108 eigenvalues, 100, let's say, above spectrum. Why is that interesting? First of all, because it means that we probably only need to compute 100 eigenvalues, so we can do the linear algebra faster. For example, if you do a SVD, only the first 100 matter. That's important. The rest is noise. What else is important? See, this is the Georges Zubelli, Tracy Whittem. It says the difference between, this is where Tracy Whittem tells you that the edge of the spectrum is, F1 of S. Okay, so now I did the analysis for US equity derivatives. S&P 500, the Bouchot result, there are 15 eigenvalues. For more options, there are 20, but more stocks. If there are no options, you get away with 20 factors. If you have S&P 500 and all options, 84 significant eigenvalues, large data set, 108 significant eigenvalues. So how do we use this? We do a Cholesky or an SVD, and then we can simulate scenarios of implied volatilities and price. However, Cholesky and SVD can be very slow. So one approach this is actually another thing that I learned from my colleagues. At this age, I'm learning how to do fast linear algebra. Has anybody here heard of randomized algorithms for linear algebra? Raise your hand. Oh, nice. Okay, we have 4 people. So, excuse me, I'm going to tell it to everybody else. Okay, so here's how it works. Fast SVD, so you want to do an SVD, but you want to do it fast. SVD means you take a data matrix, you write it like this, blah, blah, blah. But we want to get a good rank K approximation, which has a significant eigenvalues, which we already know are not very much. How do we do this? And approximate in the best L2 norm. So it's how do we compute the top K eigenvectors fast? How do we compute the top K eigenvectors of a huge correlation matrix fast? I said, this is a hard problem. Then I called my friend in California, Frank Elliott. He says, in California, we do this all the time because we're big data people. And how do you do it? You don't know? Use randomized, use this, Tigert. So what does Tigert do? Tigert says, I look at my data, and before computing it, I multiply it on the left by a random set, a pre-multiplied by a thing that has zeros and 1 distributed uniformly. And then I multiply it, and I apply the SVD to that. But this one is low rank here. It only has small dimensions. So the actual calculation has this short rank here, K, goes very fast. Why can you take a matrix, multiply it by a random matrix, and get the same result? That looks like you're cheating, right? How many people think this is cheating? Cheating, cheater, cheater. You're not cheating because the principle is essentially the same as the principle of elections. You know, elections, you take 1,000 people, properly selected, and you say, who is going to be the next president of Argentina? 60% say Macri, 30% say Scioli, then you know Macri is going to win if it was done, if the sampling is done right. It's very accurate. And here, you're sampling the stocks. You're asking certain stocks and certain times, randomly chosen, the question, who do you care about? What eigenvalues do you really care about? And they tell you. That's fast. So how fast? if you look at computational time versus size of the matrix, this is staggered. This is cubically growing in the size for SVD. This grows like nothing, doesn't grow. Okay, so this is for computation time with regular SVD or randomized algorithm. S&P 500 and all options with 9 pivots. We use 499 stocks, 2 years of observation, K equals 499. The 492 stocks times 10, because we have 9 pivots in the stock, takes 36 seconds, here 2 seconds. But we don't do this, we have to do the big matrix, and this grows cubically. So if you do the big matrix, you go from something like a day to 41 seconds, or like an hour and 15 minutes to 17 seconds. To finish, I will tell you, I did all this, meaning, I had a client, I had a person that wanted me to price 200 portfolios every night using this. So then I kept the code, and I wish I could show you more, but we built an application that does exactly this. You know, this weighs 100 kilobytes, nothing. You can just download it. And then we send you, the scenarios done by SVD and everything to your computer. It's a little problem of FTP and firewalls. Then you can upload any portfolio you have of the universe here. And this is the portfolio. And then you click this button that says compute. And it computes all the risk and all the, you can choose your risk measures. Here's the tail risk. And then you have another button that says export results, and it writes a report. So you can manage a hedge fund of option traders or a trading floor and say, we don't know what these guys trade, I just assume they trade everything. You get this service, Iceberg, then everybody's like making wild trades and so on. And then you just stop by and say, take their portfolios at any time of the day, apply this and write a report, and you can send a report to risk managers, to central bankers, to anybody who cares. And we're trying to make this into an application and give it to traders to use. We haven't finished yet because, in fact, the reason why I have a thing is because I wanted to show you the real app, but it doesn't scale very well. The problems that we have are completely non-mathematical. They're how do you display this and so on. But so holistic, because I went from and you see why you have to do it for everything, because you don't know what people are going to trade, so you have to have the whole market. So right now we can do this overnight. You can't do it intraday, but overnight I can, with the prices of the close, we can generate scenarios to price thousands of stocks like this and their options. So thank you very much.
Thank you very much, Marco. So, well, we have time. We are running a little bit late, partially because of traffic, partially because of me, but we have time for a few questions. So I'd like to invite Bruno and Marco to